Welcome back to this week's Mortgage Insider Update. Take a look at markets this week. Pullback, both pullback as far as the stock market, the Treasury market, the U.S. Treasury bonds skyrocketing on Monday this week, only to come down a little bit middle of this week, coming after the holiday. We did get a pretty major news at the end of last week with 3.7% unemployment number. That was a tick higher from 3.5% just the month before. Puts us at a little bit higher unemployment rate, but well below 4%. So really a strong jobs report. The most encouraging thing that came out last week, more people are looking for work, and there's a lot of jobs available. So as that starts to play out, the Federal Reserve is going to be watching for turns in that employment market. If the employment rate starts to tick significantly higher, the Federal Reserve Chairman said painful to households and businesses. I assume that means that the higher interest rates are likely to be painful to businesses, and when it comes to maybe payroll headcounts, that could be impacted over time. But as of right now, a lot of companies still looking for workers. We've seen a high point back in June on interest rates. We can see just from this angle here, only a couple days where we at that high point before things started to level off and came significantly lower as the summer progressed here. But with just the last couple weeks, it's become more and more apparent that the Federal Reserve is going to continue to rise their short-term federal funds rate, probably 0.75% at the end of September 21st, actually. We'll get updates from the Federal Reserve there. They're going to have two more policy meetings before the end of the year, both in November and in December. And that's just going to be the way of the world, I think, right now, is going to be higher rates. If we look at the overall market today, bond market a little bit higher. That's a positive after selling off pretty significantly yesterday. We will go to that. S&P 500 bouncing back a little bit today. It's had a rough couple of days through the end of last week. We can see mortgage bond prices. These work in inverse from the actual rate. So the consumer rate is going to be impacted as the price drops. The rate to the consumer goes up. So in a similar time period, June 14th was the low point in price, high point as far as mortgage rates go. That would hit us on June. We've seen, basically the inverse of what we showed on the 6-month chart on the 10-year. So it's not falling off a cliff. So we're going to look for positives today. The market is steady. People are able to get into properties, the homes that are available. If you've got a buyer that's ready and willing to pay today's interest rates and negotiate on the offer and get what they feel is a fair price, those deals are coming together. So look forward to helping people do that, and we'll navigate the waters as they come our way, right? Have a great day.